Hello, everybody. This is Paul Paquin at Golden Financial Services. We've been offering debt relief services since 2004, and just this year we actually broke our big goal that we've had for about the last 2 years now. We've been trying to get to 8 million clients who became debt free with our programs. And we were able to achieve that this year. So right now we have about 8.2 million clients who have successfully been able to get out of debt with our programs. And this is a great point in time for us to be able to go over with all of you folks the best ways to get out of debt in 2018 and 2019. So the subject of today's talk is going to be $25,000 worth of credit card debt. We're going to use, on average, consumers have about a 20% interest rate. So we're going to say, let's look at 5 credit cards. Each credit card has a $5,000 balance. So we have $25,000 worth of credit card debt, and the interest rate is 20%. Now, if you can afford to stay current on your monthly payments, the best option is either going to be the debt snowball or the debt avalanche method. Now, the debt snowball method, uses psychological principles. The point of this option, you make a budget, you find any extra money, you can maybe lower your electric bill. There's $50 right there that you can use. You can cut out you can start using coupons, so you can start saving $50 per week at the grocery store. You have to find extra money. Once you find extra money, then you're going to use that extra money to put towards paying off the credit card debt with the smallest balance first. Okay, so in our case, we have 5 credit cards for for $5,000 each. But let's just say one of our credit cards was a $1,000 balance. So that's the balance that we would attack first, the one that's only $1,000. We put everything we can put towards paying off that small balance first, and within 3 or 4 months, we're going to be able to get it paid off, and that's going to motivate us, right? We're going to be happy because we've achieved our first goal. We've paid off 1 out of 5 credit cards, and we're going to want to pay off the next one. We're feeling good. We achieved our goal. We paid off one of our credit cards. So now we're going to attack the next smallest debt. We're going after the smallest debt first so that we can get the quickest results and we can feel good in the quickest time frame, and we're going to want to pay off that next account. The other approach is the debt avalanche method. This approach, it doesn't matter what the balance is. We're going to attack the most expensive debt first. So we're going to go after the credit card debt that has a 29% interest rate, because that's the one with the highest interest rate. That is what is costing us the most. So if we can eliminate that high interest debt, now we're going to be able to save more money in the end because we were able to get rid of that most expensive debt first. Then we attack the account with the 28% interest rate. And we just keep going after the debts based on what account has the highest interest rate. Okay, now, these options are only possible if we can afford to pay more than the minimum payments. If you can only pay the minimum payments, let's say that you can only afford $600 per month. At $600 per month, it would take you 5 years and 9 months to pay off $25,000 of credit card debt with a 20% interest rate. So 5 years and 9 months, paying $600 per month, you're going to end up paying $43,038. So it's going to cost you over $43,000 to pay off $25,000 in credit card debt. That's the worst option you could choose. Now, you could always join a consumer credit counseling program. Consumer credit counselors will be able to go and get your interest rate reduced. You could get a 29% interest rate reduced down to about 12%. In some cases, you can get it down to about 8%. Basically, you're going to cut your interest rates in half, in most cases, when it comes to consumer credit counseling. So instead of taking 6 years to get out of debt, maybe you'll get out of debt in 4.5 to 5 years. With consumer credit counseling, it's 4.5 to 5 years. That's how long the program lasts. Okay? Some people want to get this done much faster. They want to get out of debt in 2-3 years, but they can only afford $600 per month. So if that's you, okay, you can only afford, let's say you can only afford to pay minimum payments. So you can only afford to pay $600 per month. You could have your debt settled, and if you do what's called debt settlement, you're at $600 per month. You're looking at, well, even better, with the debt settlement program that we offer, your payment would be only $475 per month for $25,000 in debt, and you would be completely debt-free in 36 months. Now keep in mind, debt settlement will hurt your credit score because your creditors don't get paid on a monthly basis. You basically have to stop paying your accounts. Each of your credit card debts will get written off and sold to a debt collection company, and then we would go in and settle the debt for about half. With fees included, you're going to end up paying about $17,102. That's what you're going to end up paying on $25,000 in debt. So you're saving a significant amount when it comes to debt settlement. You're paying much less than the full amount owed. Now, if you're going to do debt settlement, 9 out of 10 of our clients who qualify for debt settlement, they don't want to ruin their credit. They don't want to stay in a program where they're going to be left with late marks and collection marks on their credit report. So 9 out of 10 clients are doing what's called debt validation. Once your debt gets written off and sold to a third-party debt collection company, we challenge the debt. We use 14 federal laws to challenge the debt. And I have not seen one case in 5 years where the credit card company or the third-party debt collection company could prove the debt was valid. So if we dispute the debt 9 out of 10 times, what's going to happen is that the client will receive a letter in the mail, and basically the letter is going to say the debt collection company is agreeing to stop collection on the debt, and in most cases even remove the derogatory information from our client's credit report. So you're getting, the debt is becoming what's called legally uncollectible. A legally uncollectible debt is one that you don't have to pay. Now, there's a longer process in place. For example, the debt collection company could send the account back to the original creditor, and then the original creditor could sell the debt to another third-party debt collection company, which in that case, we would have to show, here's the proof, this debt was already proven legally uncollectible, and that's what's called a defensible record that we use to show that the debt is actually invalid. So with debt validation, you can actually save more money than if you were to do debt settlement. With debt validation, a 36-month program would cost you $357 per month based on $25,000 in debt. So that's quite a bit lower than the $475 payment that debt settlement would cost. So with debt validation, you're going to pay less, plus you get a money-back guarantee, and you get credit repair included. So once you stop paying on your credit cards, okay, your credit's going to take a hit regardless of what program you use. And to rebuild your credit score, you need to establish new credit, pay on that new credit, and basically start fresh. You have to get another credit card or an installment loan, make payments on it, and rebuild your credit score. So part of the debt validation, we include credit restoration, and part of what that includes is an installment loan. So there's a bank that we work with that will issue an installment loan to the client in some cases, if they need it, just for the purpose of helping them to rebuild their credit score. And then, of course, the credit repair will dispute any of the derogatory information on our client's credit. Now, keep in mind, so the credit card companies that they ended up selling the debt to a third-party debt collection company. Then we disputed the debt with the third-party debt collection company, and then the third-party debt collection company has agreed to stop collection on the debt. So they're no longer collecting on it. They're no longer calling the client. Now we dispute the negative marks on the client's credit. And since the debt collection company stopped collection on the debt, they're going to ignore the dispute. Now we get the negative marks off our client's credit report, and the program has basically done its job. So these are the options that you can turn to. We don't recommend you take a debt consolidation loan out, because now you're just getting a new debt and paying off your old debt, and it's basically replacing one debt with a new debt, which is not really a solution to your $25,000 in credit card debt. So it's not something you want to do. If you have any questions, go to goldenfs.org. Okay, that's www.goldenfs.org. And just select your state, and then you'll be able to read about all of your state's debt relief programs for 2018 and 2019.